It wasn't a supply chain disruption. It wasn't a sudden shift in industrial demand. It wasn't even a speculative mania driven by retail traders. It was the inevitable mathematical consequence of a monetary system reaching its terminal velocity. The pattern is unmistakable. History does not whisper, it shouts when an empire chooses the easy path of currency debasement over the hard path of fiscal discipline. The ratio between paper promises and physical reality snaps back. The arithmetic is merciless. We are looking at what might be the most undervalued asset in the world, not because of a chart pattern, but because of a historical constant. Silver is not just a metal, it is a barometer of systemic trust, and the barometer is breaking. We will examine this through three specific historical case studies: three empires, three collapses, and the flight to hard assets that define them all. Rome. The crisis of the 3rd century. The denarius was the standard, once 98% pure silver, the backbone of the legion, the envy of the barbarian. Then came the costs. The borders expanded too far. The bureaucracy swelled to large. Nero in 64 AD began the cheat. He lowered the purity just a little to pay the troops without raising taxes. It worked for a moment, so they did it again. By the time of Emperor Aurelian, the coin was a copper slug dipped in a silver wash, barely 5% purity. The result was panic. Prices soared, trust evaporated. The legionnaire found his salary could no longer buy a loaf of bread. Think about the merchant in the Forum holding a bag of copper slugs, watching the man with the old heavy silver coins buy the entire street. The incentive is survival. The risk is holding the state's promise. The rational move is to hoard the metal. Just like Rome, the industrial age offered no immunity to this logic. Weimar Germany, 1914 to 1923. The Kaiser needed to fund a war. He abandoned the gold backing of the mark. He printed defeat, followed reparations, crushed the budget. The government chose inflation over insolvency. The printing presses ran 24 hours a day. The paper mark lost all meaning. In 1919, a silver ounce cost roughly 12 marks. By November 1923, it cost billions. Consider the factory worker in Berlin paid twice a day rushing to buy vegetables before the price doubled. But look at the asset owners, the family who held silver, cutlery, or old imperial coinage. They bought apartment blocks for the price of a dinner service. Wealth was not destroyed. It was transferred from those who held paper to those who held metal. Just like Weimar, the modern era repeats the cycle with terrifying precision. Venezuela 2013. To present the oil price crash, the social spending did not. The government printed the bolivar into oblivion. Estimates range on the final inflation rate. Some say 10 million%. The currency became trash, literally woven into bags and sold to tourists as souvenirs. But in the mining region of El Callao, commerce reverted to the archaic shavings of silver and gold measured on scales, used to buy antibiotics, used to buy passage out of the country. The stock market in Caracas nominally soared, but in real terms, in silver terms, it went to zero. Those with metal survived, those without start. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The currency is a certificate of claim on a physical commodity. Trust is high, inflation is non-existent, and the economy grows on the back of savings. And production. Stage 2 is overextension. The state acquires liabilities, war, welfare, or infrastructure that exceed its tax revenue. The arithmetic implies a ceiling, but the political will demands growth. Stage 3 is the turn. The government unlinks the currency from the constraint. In Rome, it was alloy mixing. In 1971, it was the closing of the gold window. The incentive is to delay pain. Stage 4 is the illusion. Prosperity seems to rise, asset prices climb, the stock market roars, but this is not value creation, it is currency devaluation masquerading as growth. Stage 5 is the awakening. Inflation moves from assets to consumer goods. The cost of living squeezes the middle class. The authorities blame speculators, supply chains, or foreign actors. Stage 6 is the flight. Smart capital realizes the game is rigged. They exit the currency. They move into land, art, gold, and silver. This is where the physical shortage appears. Stage 7 is the reset. The currency is destroyed or redenominated. The transfer of wealth is finalized. Just like the flight to safety in the 1920s or the 1970s, current data suggests we are deep into the later stages of this cycle. The warnings are flashing. Central banks are buying gold at record rates. The deficit spending is mathematically unsustainable. The ratio of paper contracts for silver to the actual physical silver in the vaults is at historic extremes. Here is the key. Silver sits in a unique position. It is both a monetary metal and an industrial necessity. It is used in solar panels, electronics, and batteries. Many historians argue that while gold is the money of kings, silver is the money of the people. It is the transaction mechanism. For the crisis, the industrial consumption of silver means that unlike gold, which is hoarded, silver is consumed. It disappears from the market. We are facing a scenario where monetary demand meets a structural supply deficit. One interpretation is that technology has changed the game. Critics argue that digital currencies or equities are the new inflation hedge. They say metal is a relic, a barbarous rock with no yield, but consider the counter-argument. In a crisis of counterparty risk where institutions fail and ledgers are frozen, digital assets rely on the very infrastructure that is under stress. Metal relies on nothing but physics. The incentive for the industrialist is to secure inventory to keep the factory running. The incentive for the saver is to secure purchasing power that cannot be diluted by a central planner. When these demand curves collide, the price suppression breaks. The risk is not in holding the asset, the risk is in holding the currency that measures it. The endgame approaches in one of three ways. First, we see controlled decline. This is financial repression. The state keeps interest rates below inflation. They slowly liquidate the middle classes' savings to pay down real debt. This was the strategy of the post-World War II era. Specifically from 1945 to 1980, silver performs well here as it tracks the real inflation rate that the government CPI ignores. Second, we risk chaotic collapse. This is the Weimar or Zimbabwe scenario. Confidence snaps overnight. The currency is rejected. Commerce stops until a hard asset is adopted as the medium of exchange. In this scenario, silver becomes the primary mechanism for daily survival. Third, and most likely is a reset and restructure. The authorities introduce a new system, a central bank digital currency, perhaps backed by a basket of commodities to restore trust. In this scenario, the revaluation of the underlying assets, gold and silver, is the mechanism used to clear the debt. This happened in 1934 when the U.S. revalued gold from $20 to $35. The only variable is timing and pain. Subscribe to the channel. We are tracking the ratios. The industrial drawdown and the monetary base expansion preparation is not about panic. It is about education and resilience.